Preceding slides, we have seen the transactions that lead us to a very important measure of the net flows of goods, services, income um, between a country and the rest of the world, and this is the current account balance. Now, we can combine the information we get from the current account balance with the fact that we know that when we sum up all the entries that are recorded in the balance of payments, we need to get a zero. So imagine that the current account balance, which again is a measure of this flow of goods, services, and income receipts between a country and the rest of the world, imagine that this number is positive. Then, in a sense, this means that there needs to be a compensation after so that we get to the overall balance to be equal to zero. And so imagine that the current account balance is positive. It means that we have some sort of like excess of money that has gone from foreigners to residents. So if we think about it, the plus transactions, the credits in the balance of payments are transactions such that money goes from foreigners to residents, and the debits are transactions such that money is going from resident to foreigners. If we have a current account balance that is positive, it means that we have more currency going to residents than currency going from residents to foreigners. So we have kind of an excess of currency, and this needs to be invested, needs to go out of the country. Buying, purchasing assets that are not local, but they are foreign assets. So it means that when I have a current account balance that is positive, there needs to be an outflow of financial resources, which means that the financial wealth of my local economy in the rest of the world has to increase, has to improve. So again, the net financial wealth position with the rest of the world of my country needs to improve, meaning that money needs to flow out if the current account balance, which summarizes all these flows of goods, services, and income receipts, is positive. If the current account balance is negative, the opposite is true. It means that there's been a lot of currency flowing out of the country, in a sense. So there's been more recorded transaction as debit than credit. So I have given out more money than what it has come in a sense. So to compensate this imbalance in the current account, it means that investors from abroad, which have excess money in a sense, because as I said, more money has been going out than it's been coming in, they have to invest in assets in the local economy, or I have to disinvest as a resident in assets in their economies. This will mean that the foreigners' wealth position with my country is going to improve, and my country's position, so the local economy's net wealth position with the rest of the world, is going to deteriorate. This is why the current account balance is so important. It's a number that alone will tell us what will happen to the net financial asset, financial wealth position of my country is evolving in comparison with the rest of the world.